Hi, this is the PowerPoint to Chapter 9, Budget, Part 1. The budget consists of an income statement budget, balance sheet budget, and cash flow budget. You should also be familiar with these ratios because you should assess your drafts when you have made them to see if everything is satisfactory or not. You should also be able to calculate these turnover ratios because you are using them for the cash flow budget. There are a lot of aspects and reasons for making budgets. All of them are important, but maybe coordination between activities, that means sales and production and so on, is of course extremely important. Communicate plans also extremely important. New ideas, very important. Create internal interaction, very important. You could, in principle, do it in two different ways. You could start with the management stating what should the goals be, the profit level, and so on, and then the different departments can start working until they have a budget that will fulfill the requirements. Or you could start in another way. We call it build-up approach. Each department will make their own estimates, and then you put it all together in an overall budget, and then you see what happens. And then you will, of course, start one more time if it is not okay. In real life, it is a combination of these two. The procedure is normally like this. We call it passive plans. That means we start looking at what happened last year or current year, and then we see. Of course, we take into account what we know has happened, internal and external. For instance, new taxation rules. Maybe a competitor started up next door and so on. And when we have done this, we start with the active part. That means we take into account new initiatives, new products, new markets, new technologies, whatever. And then we do our total planning, and then we calculate the economic consequences of this plan. And then if it's not okay, we start all over again. And then we end up when we are satisfied with the final budget. You could also show it like this, analyzing current situation and targets. The plans will lead to a budget, draft number 1. We draw up the budget. We, of course, coordinate and evaluate. And then maybe we have to change plans, come up with some new ideas. We make draft number 2. We evaluate and find it okay. We do the approval, and then we have an information meeting, probably, where we inform the total organization, and then we make the implementation. This is two different ways of doing the activity budgeting, direct and indirect budgeting. Activity budgeting, we call that the budget when it comes to sales price, sales volume, variable costs, and sales promotions costs. We call that the activity budgeting. And then we have the capacity cost budget and financial cost. But when we are talking activity budgeting, we talk about direct or indirect budgeting. In the direct budgeting, we have sales price per unit, sales volume, cost price per unit, and then we can calculate the total revenue or turnover and the total cost of sales or variable cost. Normally, we do that when we use this method when we have a limited product range. If we have a lot of different products, we sometimes use indirect budgeting. For instance, a shop selling vegetables and fruit. They have so many different kind of products, and it's difficult to manage the units. So therefore, we work with the turnover and the gross margin or contribution margin. So it's two different ways: direct and indirect budgeting. Here's an example of direct budgeting. We have a sales price, we have a cost price, we have a promotion cost in total, we have sales commission and sales volume. And the total cost price per unit is 80. So we have a turnover of 8,000 units and sales price 150. That is 1.2 million. Then we have variable cost, 8,000 multiplied by 80. That is 640,000. Contribution margin is 560. Then we have promotion cost, and then the marketing contribution is 500. This is direct activity budgeting because we have units and we have sales price per unit. And here is an example of indirect budgeting. We had last year a turnover of 1.5. We are told that we expect a change in turnover plus 10%. That means next year 1.65. We had last year a gross margin of 1/3. So if we have the same gross margin next year, it will be 550. This is indirect budgeting. We don't have volume units, and we don't have sales price per unit. The components of a budget was, as stated before, income statement budget, showing the expected earnings, cost, and profit for the year, and the cash flow budget show whether the company possesses sufficient liquidity to carry out the plans. And balance budget is normally just a kind of control to see that you have remembered all the different accounts.